Hello, everyone. Thanks for joining us. I'm Ty, your moderator for today's program, Unlocking Financial Wellness with Secure 2.0, presented by HRMorning and sponsored by Ubiquity. Before we dive in, just a quick note. If you have any questions, please type them in the chat box in the control panel. If they're regarding the subject being presented, I'll add them to the queue for questions at the end. Now let's meet today's experts. We have Chad Parks, CEO of Ubiquity, and Mona Dillon, VP of People and Culture at Ubiquity. Welcome, Chad and Mona. Thank you for joining us.
Thanks, Ty. Happy to be here, and chat will kick us off.
Yes,
Perfect.
Good morning, Ty. Good morning, everybody. Thank you for having us. We're very excited to share our topic with you all today. Many of you have probably heard about Secure 2.0 as it relates to major overhaul of retirement plan legislation following Secure 2.0, which occurred Secure 1.0, which occurred a few years ago. So there's a lot of information that is in Secure 2.0. It affects some 75, 80 different areas of retirement plans. But what we wanted to do today was to break it down into those that are most relevant and most important to you, the HR professionals, so that you know what to expect when it comes time to have to implement or consider these provisions in your own retirement plans that you may be administering or those that you're contemplating putting in place. So we're happy to share that information with you today.
Thank you, Chad. And let's dive right in. Chad, I'd like to start with you. How has Secure 2.0 changed the landscape of retirement benefits for small businesses?
So Secure 2.0 is a result of many, many years of realizing that there's a lack of retirement plan coverage in the small business marketplace. When we say small business, generally speaking, you can call that 100 lives or less. So to us, that's a small plan, a small company. So what we've seen is statistically over the years, something like 72% of small businesses in that category don't offer workplace savings of any kind. It's a very much needed benefit. And so what's happening is both state governments and federal governments are realizing that it's going to take a bit more than a nudge to get people off the fence and to get them into the retirement savings system. So they've created a whole bunch of incentives as well as some mandates that we're going to talk about as well in order to address that undercovered market. And I want to also stress that, when we were talking about 100 lives and under, the majority of those businesses are really in the 2 to 20 space. Something like 90% of businesses under 100 lives are in that 2 to 20 space, literally millions of businesses. Traditionally, and it's the fault of financial services industry, so I apologize on behalf of our competitors and those who have come before us, they generally ignored that market because they couldn't figure out, frankly, how to make money in that market. Most of financial service companies who provide retirement plans are in it to manage the investments, and they charge an asset under management fee. And so you can do the math. If there's very little savings, very little money coming into that plan, they cannot figure out how to generate enough revenue to support that plan. So that really kind of explains why there's such a lack of coverage in that end of the market. But in today's world, with technology the way it is, and the internet, and our ability to distribute and have everything digital, and with good pricing models that make it affordable for small businesses, and now combined with tax credits, which can literally pay for our fees for the first 3 years, I think we're going to see a new era of interest and adoption of these small business retirement plans.
Thank you, Chad. And our next question is, what are the most significant tax incentives introduced by Secure 2.0, and how can small businesses leverage them to make retirement plans more cost effective?
Yes, as I alluded to there, let me break that down a little bit for you. So there's some math, but we're going to use a simple example. What Secure 2.0 has done has created 3 different distinct tax credits available to the small business owner. First and foremost is a tax credit to offset startup and administrative fees related to the running of a small business retirement plan, particularly 401ks. That tax credit is a mathematical formula which goes along the lines of $250 per eligible employee, not to exceed $5,000. So if you're a 20-person company, you are eligible for the full $5,000 per year for 3 years tax credit. If you're a 10-person company, then that tax credit is about $2,500 available to you. So you get how that math works. If you're a 30-person company, you still are at the limit of the cap of $5,000. Now, there's a second category of tax credit, which is the automatic enrollment tax credit, which you might have heard about. Some plans have voluntarily adopted automatic enrollment. Starting next year, all new plans going forward will have to automatically include automatic enrollment as a default option. So in order to help offset any additional administrative burden or complexity, there's an additional $500 per year for the first 3 years tax credit available to that small business owner. So in essence, you can use round numbers of $5,500 available for 3 years, so $16,500 over that 3-year period. How does that compare or play into our fee structure? So Ubiquity Retirement and Savings is a small market provider that we have a pricing model that is simply strictly fee for service. We don't charge any asset under management fee. We don't charge any assets under administration fee. So that means that more money that people are saving stays in their account and works for them. So we have a small monthly fee we charge to the employer, and we have a small participant fee that we charge to the employee. In order to maximize the tax credits, what we'll do is we'll shift that employee fee over to the sponsor, to the plan sponsor of the employer, and put that on the invoice. So for example, you can see here, this is an average cost that we charge for a small business retirement plan. First year with a setup fee, around $2,700. Second year, $2,250. Third year, $2,250. So our fees only total about $7,200 over that 3-year period. And you can see that the tax credit exceeds that. So when we say that these literally can be free retirement plans, zero out-of-pocket cost to that small business owner for the first 3 years, that's what we mean. So that's just an example. Obviously, each situation is unique. The small business does need to have a taxable income in order to take this credit. However, in the event that a small business is not have a taxable event in that particular year, maybe they had a loss, they can still claim the credit and roll it forward for future use. So it's not completely lost. You can bank it and use it in the future. The third and important tax credit that the Secure Act 2.0 has allowed is what is called an employer contribution tax credit. So they're really trying to incentivize small businesses to put money in on behalf of their employees. And traditionally, this has been an area that is a cost of doing business. Some employers are not interested in doing that. So the government has said, look, let's get you going on that path. So if the small business is willing to fund a matching, not a matching, but an actual employer contribution, it's not a match, to each employee who's eligible for 5 years at $5,000, so $1,000 a year, they will reimburse $3,750 of that contribution. So really, you can see they're really trying to prime the pump and get business owners excited about and getting their employees excited about saving for their retirement. There's a lot more complexity to it than we can go over in today's webinar, but we just wanted to let you know those are the 3 major tax credits: startup and administrative tax credits, auto-enrollment tax credit, and employer contribution tax credits. And as an example, in a 20-person company, over that 5-year period, those tax credits could add up to $60,000, $70,000, $80,000 of real tax credits. So these are real numbers to pay attention to.
Thank you, Chad. And moving to Mona. From an HR perspective, how will Secure 2.0's changes affect employee engagement in retirement plans?
So I think what Secure 2.0 is doing, there's quite a bit of changes that will happen, especially for HR employees, for the features of like auto enrollment, auto escalation. There's a catch-up contribution, there's Roth matching. And so I look at it as like it is going to really drive employee engagement, because now we have part of a comprehensive benefits package, and you're enriching your retirement plans with those, and you're giving your long-term part-time employees, which are employees that work 500 hours, 2 consecutive years, and they're eligible to participate. Your RMD, the required minimum distribution age, changes to age 73 by 2033 and 75 thereafter. And so all these things will actually have an uptick and a positive impact on employee engagement.
Thank you, Mona. And what best practices can HR adopt to increase retirement plan participation?
I think the key is having a really effective communication strategy. You have, as an HR professional, you can't do a one and done. Like, you have to have this constant campaign. So webinars, email, information sessions, customizing messages for different demographics, explaining sort of the benefit of this for your financial future, right? So tying those threads together is really, really important, because have experienced this over my career. Like, you could send out one email and people forget about it when they start, right? You have to constantly educate people. Hey, we have this great benefit. This is what it's doing for you. And having, what I call like office hours, sometimes those work really well because people are like, I really don't know. Like, you're just taking something away from my paycheck, but I don't understand what it does for my future. So if you take that approach of educating through threads of communication via email, via webinar, whatever works for your employee base, that will really help not just build the engagement, but from an HR practitioner, the value that we get in people participating and thinking the HR business partners is incredible.
Thank you, Mona. And what practical steps should small businesses focus on beyond Secure Act requirements to strengthen their plans and ensure long-term success?
I think the biggest key is clear communication and transparency, right? People, they shouldn't feel like, hey, something is being taken from my paycheck, right? Because it's going towards your retirement. You're not, and as an employer, you're not taken away. It's not a tax. So clear communication is key. Framing new benefits as opportunities to save more for retirement, like that is really the big key in here. And working to simplify payroll and benefits integration, that sort of like comes as part of this territory.
Perfect. And let's bring Chad back in as well. This question is for both of you. How can Secure 2.0's new provisions improve financial wellness for small business employees?
So before I started Ubiquity, I was a certified financial planner and a registered investment advisor. And so I would sit down with individuals and small business owners themselves and their employees and really help them to understand what these complex financial mechanisms that are available to us can really do for them. And I got to admit that, it's a difficult subject for most people to wrap their heads around. And I felt like it was very unfortunate that I had to go to grad school to learn the basics of personal financial planning. So what we've tried to do here in our industry is, first and foremost, make these plans available on a cost-effective basis to employers, demystifying some of the rules and regulations that surround them, making it very easy for them to interact with us and therefore to then engage with their employees. Just overcoming all those hurdles is really what keeps most away from this type of solution. But once we're successful and we've engaged that business owner and they implement a plan and they work with us or another company like us, really then, like you just asked, the challenge is how do we make sure that those employees understand the true value of this benefit and that they are excited about it and that they take advantage. Unfortunately, human nature is what it is. Inertia stands in the way often of progress and success. Not knowing what to do sort of paralyzes people, and sometimes they make no decisions. So what you've seen, not only from the industry in terms of technology and the ability to help employees get over those hurdles and kind of do a lot of things for them, is also for example, Secure Act and some other legislation that has given us the abilities to, like I mentioned earlier, really give that hard nudge to individuals to get going. So auto-enrollment is a great example of that. I believe that the statistics show that something like 80% of employees who are auto-enrolled stick with it versus voluntarily adopting, which the rates are around 60%. So that extra 20% bump of participation in a retirement plan comes because of auto-enrollment. The idea of choosing an investment or choosing how much to save has always been a real struggle for individuals. So in order to overcome those obstacles, what we have available to us, you heard Mona reference that, is auto escalation. So with auto enrollment comes a number that is chosen. It's not regulated, it can be chosen by the employer and your provider. Most are starting around 3%, but you could start at 5% of pay and escalate after every year after. But just starting to take a deduction from that individual's paycheck and put it into the retirement account. Now, there is a safe harbor window, so to speak, of I think about 60 or 90 days in which that employee who maybe didn't negatively or who did not opt out of auto enrollment has the ability to say, hey, sorry, I wasn't really paying attention and I would like to not participate and I'd like my money back. So those mechanisms are there. Yes, it does require a little bit of an extra administrative burden on HR and payroll and us, but that's okay. It's worth that effort to get the rest of those folks in and up and saving. The next obstacle, as I was alluding to, is how much, not how much, but what do I invest in? You know, this world of investing, mutual funds, ETFs, collective investment trusts, stocks, bonds, it's all very confusing for people. So luckily, again, regulation has given us the ability to help people to do it for you within certain boundaries as long as we are acting as fiduciaries on your behalf. And so what's available today are a series of different approaches, but you'll see most common is what is called a QDIA. We love our acronyms in this industry, so I'm sure HR has plenty too. But QDIA stands for Qualified Default Investment Alternative. But really, in plain speak, what that means is either based on age or if the participant actively engages in a risk tolerance questionnaire, we can default them into an investment that we believe to be appropriate based on what we know about them, which is very little, but at least it's a start. So oftentimes QDIA funds are very safe and stable. They could be a conservative portfolio. They could be a target date fund, which is equated to that person's current age with an expected time horizon of when they are expected to retire. So we've overcome that hurdle so people can be auto-enrolled. There's an amount chosen for them to save, and we automatically choose an investment for them. This is not meant to say that still they don't have control. They of course can go in there, and if they want to educate themselves and learn more and make their own decisions, they of course can always do that at any time. So those are the three big examples of how we can increase employee engagement and get people on the right path. And then you could take it a few steps further, which you'll hear a lot of buzz about, and I think it was actually, financial wellness. What does that mean? Financial wellness means a lot of things to different people, and frankly, it's a very difficult thing to bring to a large audience through through a retirement plan, through a computer screen, when you don't actively have engagement with that person. So in many cases, sometimes if a small business has a desire, there can be a financial advisor attached to this type of plan. And that financial advisor's role is to really be what I would call a retirement readiness expert. It's that person who's going to be the face of the plan, that person who you have a relationship with. They're going to get paid for their services, and they're going to get paid for their services through the plan assets, but that's okay if they add value. And if they sit down and they do enrollment meetings, or they talk to the employees, or they answer questions about other things that are going on in their life, just to give them the perspective of this one account is important, but we also recognize that you have a complex financial life. And the reality is, though, also we have to understand not everybody can afford to save a lot. Not people have issues with debt. Obviously in today's economy with the inflationary environment, money is tight. But really what we try to stress and recommend to everybody is don't discount the ability to save, even if it's a little bit, because we have stories of people who have accumulated over their lifetime $65, $70, $80,000. Doesn't sound like a lot today, and in some of our industry would actually put that price, that number over your head. You've probably seen those ads, people walking around with 1.2 million, 1.6 million over their head. That's like almost an impossibility for most people to even imagine. But that $70, $80, $100,000 that they've saved over their lifetime will make the difference between having choices and a little dignity in retirement when they have to draw Social Security, and if they're lucky enough to have some sort of a pension, at least they'll have that nest egg to draw upon. And we've seen it time and time again, especially myself in a financial practice, and including my own mother, who ran out of money at age 78. It got her to that far, and thankfully she had a good son to help her. But we don't want everybody to be in that situation. So I'm on my soapbox a little bit, as you can tell, but this is one of those areas that's near and dear. It's really important to focus on the individuals and give them that peace of mind and get them on the right path to savings.
I don't think I can add much to that, Chad. You covered a lot of ground. And so I will say, like, what Secure 2.0 really does to improve financial wellness for small business employees is like give them access, right? Give them a robust pathway so they can save for the future. And I think the provisions, especially for the long-term part-time employees to participate because they have the desire to, I think creates that. I think I'm just going to share one piece of data. SHRM, because all of us HR professionals love to lean on SHRM for data. They have an interesting piece that says 82% of the employees consider retirement benefits as a critical factor when they are considering leaving, and 74% of employees will take retirement benefits into account when accepting a new job. So when you think of that statistic and you think, hey, is retirement that important? Because we have this whole host of benefits on the other side, medical, dental, all this like great things which other small businesses don't offer. But when it comes to people's financial future, there's more and more awareness and stress around that. So Secure 2.0 is elevating and creating pathways of saving. So I think that is the only piece of information I can add there.
That's a great point. Thank you.
Thank you, both of you. It's pretty clear that financial wellness is crucial for employee satisfaction. Let's now shift our focus to the broader. What is the biggest challenge small businesses will face when implementing the changes required by Secure 2.0?
So I'll start with the technical and tactical. For those who don't have a plan in place today, there won't be any adjustments they need to make, but for those who are considering a plan, now has been a better time than ever to actually go ahead and implement that plan. For companies who have plans in place, and a lot of the HR professionals on this webinar probably are thinking about that. As I mentioned, there was something like 75 or 80 provisions within Secure Act. Not all are applicable to everybody, and not all are required. Some are optional. For example, the notion of applying some part of matching or an employee's contribution towards their student loan debt. That's a great concept. It does kind of take care of this issue of which do I do first? Do I save for retirement or do I pay down debt? It sort of combines that. So it's a great approach from a implementation standpoint. We as an industry still need to figure out how that's actually practically going to work. As Mona talks about, great funds, making keepers can earmark that money correctly and keep track of it, as well as making sure that that student loan debt is actually paid, right? So you can see best laid ideas have a lot of practical and tactical obstacles to get that up and running, but that's one that's coming and it will be optional. And you'll probably start to see that happen at the larger plans first, as we all figure out how to actually implement that successfully. The other things, and Mona, why don't you take most of this because it's very much in the HR focus, LTPT, age requirements, etc.
Perfect. So I think where HR sort of has to pay attention, as you covered, auto-enroll, auto-escalation, but I think in there the communication comes in handy where it's like, hey, 50% of the respondents who automatically enrolled in new or existing plans is up 39% from 2018. These are, again, data points from SHRM. 26% of auto increase employees is also up 18% from 2018. So initially, when these Secure 1.0 and these features came up, people were hesitant, like, hey, why should we take this paternalistic view and enforce this? But the value is there. The data indicates there's uptake there. So like plans require us to do that. And there's a 30-day opt-out period, so communicating that clearly and ensuring the plans can accommodate for the catch-up contributions. You're ensuring you have your LTPT employees eligible and communicating to them is sort of key. And Chad, correct me if I'm wrong. I think those are most of the features.
You mentioned it briefly, but now we're drilling down on this. The second tier of catch-up contributions, which is age 62 to 64.
Thank you. Yeah, that one. Those become eligible, and the RDM age is higher.
Yeah, the RMD, required minimum distribution.
RMD, sorry. Yeah.
Is going up from 70 and a half over the next several years to, I believe, 73 and then 75. So these are all the tactical things. And frankly, as HR professionals, you need to make sure that you're aware and that you are adhering to the rules. But honestly, that burden should be with your retirement plan provider. So what you need to do to answer Ty's question is to go back to the providers and say, listen, I attended this really great webinar today, and they told me that we have all these things to be concerned about. Where are you on the path to having your systems be compliant with the requirements of Secure 2.0? And where are you on the path of having your systems able to do some of the optional things that Secure 2.0 is offering us. And so that's a fair and legitimate question you can ask of your provider, because like we said, if you, as these dates come and as these things become requirements, that is an area that you will want to focus on.
Thank you.
Sticking with adhering to rules, what compliance challenges do businesses face with navigating both state and federal mandates?
So, okay, you see this, let me just start off here. Okay, how do I even answer that question? Infinite number of rules and regulations that every small business in this country has to worry about, down to the local level. And I know you all as HR professionals completely appreciate that. You know, I know that even in the state of Pennsylvania, you can have one county on one side of a road, another county on another side of a road, and it has different tax withholding requirements, right? So these things are tough to really administer. Fortunately, unlike health benefits and unlike payroll, retirement benefits live at a little bit higher level, right? So let's remember that retirement benefits are governed by the federal government. It is an IRS provision that allows the tax treatment of retirement plans savings, both pre-tax and post-tax. You know, so Roth is known as post-tax. The rules as it relates to profit sharing contributions are governed by that. And then the Department of Labor has some oversight as it comes to administering ERISA provisions, and the rules that we play by in terms of non-discrimination, top-heavy compliance testing, Form 5500 filing, all those things that go into running and administering a retirement plan. Now, those are the federal level, and again, any good provider that you work with should be ensuring they're holding your hand and taking you through all that together. There isn't so much as a federal mandate yet, and I say yet because really depending upon, well, today's election day, I just realized, depending upon where all this goes, we could, you know, in the strange event that we have a democratically controlled Senate, House, and White House, there has been talk that in the next 2 years, there might be the idea of a federal mandate coming out of Washington. I know that Chairman Richie Neal of the House Ways and Means Committee, when he was chairman, has floated a bill that actually does say that. But don't worry about that right now. These are all speculative. But let's focus on what is at hand. And you see on this map here, you might have heard, you might have employees in, you might be a business in one of these states. California, Oregon, and Connecticut were really the first three to start this initiative. And what they're talking about is requiring businesses in their borders to offer, quote unquote, some sort of retirement plan. Okay. Now, some sort of retirement plan, a 401k, a payroll deduct IRA, a simple 401k or a simple IRA. A lot of plan types qualify. They just really want to get companies into the system. Some states have more of a stick approach, with there is a mandate and there would be penalties if you do not comply. I know that California is moving into that phase. Other states offer more of a carrot approach, like Maryland, to say, if you would please offer yourself and your employees a plan, we'll give you some tax credits. You know, so they're trying the carrot approach. So you know, for those of you who understand and know Baskin Robbins, you know, 31 flavors, and that's what we're dealing with here. We're dealing with 31 flavors of different state rules and regulations as it comes to whether or not they're requiring and how they're going to implement and enforce retirement savings. This is just the beginning. This has been going on for, you know, probably 10 years now. More and more states are aligning. What I'm part of a Georgetown University Center for Retirement Initiatives that has really helped these states gel on their outlook, on their commonalities, on trying to create consistency amongst themselves. And we're starting to see states sort of borrow each other's infrastructure. So the idea of having 50 flavors hopefully won't become reality as we start to see some more homogeneity amongst these different plans. But the idea for you HR administrators is, what do we need to know? What do we need to do? This is not meant to answer that question today. It's just to put that question out there. Do use this map as a reference, but do dig into it yourselves. So the initiative, and you have to ask yourself why are the states doing this? It's because they understand and realize, as I mentioned earlier in the presentation, you know, we have millions of small businesses that translates literally into almost 60 million workers at those small businesses who don't have retirement plan access at their job. And it's been proven that the best way to save is through payroll deduct. So these states have taken the initiative. They understand that if this problem is not solved, that this will become a pull on social services at the local level, social services at the state level, and eventually social services at the federal level. So that, to the policymakers' credit, while it may seem draconian or, oh no, government's in my business again, this one really does have a long-term positive effect. And I often like to compare and contrast this to the Affordable Care Act. So my company was headquartered in San Francisco, and we were there before the Affordable Care Act was implemented. San Francisco took upon itself to implement a mandatory health coverage for workers in the county of San Francisco. They set the bar at $350 per employee per month that the company either had to contribute to a general fund so that the employees could go and take services from the county hospital, or they had to provide health coverage to that rate or better. So, and that's kind of what Affordable Care Act is. I'm not going to tell you all because but if you're a 20-person company at $350 a month, that's about an extra $80,000 a year of mandated expense that the county says you have to spend. So that's hurtful to a small business. That could be their profit margin. So I understand when people are very upset about government intervening and forcing businesses to do something. But what I really want to take full circle here is to go back to that. We don't have to literally go back, but in your mind, go back to that slide where I talked about the tax credits. Retirement savings is so inexpensive relative to other benefits that it's almost negligible. And the fact now today that the federal government is offering tax credits to basically zero out the cost for the first 3 years should remove those barriers. So it's not an apples to apples comparison to say forced healthcare is the same as forced retirement. So I just really want you to be honest with that and look at the math. And then the other thing I like to kind of soften this with is, you'll probably remember, some of you, when workers' compensation was not required. And so, that was an optional benefit at some point, and it is required in all but one state. I'll leave you all to guess which state does not require it. We'll just say that, the stars at night are big and bright. But so 49 states require workers' compensation, and that is a trend that we see mirroring in the retirement space. So just get ready for it. Remember that some sort of retirement plan will meet the mandates. I would say that one thing I did leave out of this is that Secure Act also created 2 new product types. And one is what is called a starter K, and the other is called a PEP. We won't go into the details greatly here, but know that those types of plans would also satisfy the mandates. And a starter K is really just that. It's in its name. It's a 401k on training wheels. It doesn't have mandatory matches. It doesn't have contributions allowed. It doesn't allow for loans, and the savings limits are the same as an IRA, but it uses the 401k infrastructure and the 401k chassis, if you will, to be able to mirror that of a larger, more impactful type of plan to get people a place to start. So we're excited about Starter K as well, and Starter K should be something that you should take a look at if you think your company could benefit from that.
That's awesome. Thank you. That is such a great, such great information, and also really great segue into sort of like from an HR professional navigating that map, depending on where you have employees, is not easy for an HR professional. Usually it'll be like one person who's either also doing finance and accounting and HR for small businesses in instances where you're not already overloaded with your day-to-day, you have all this legislation coming at you. The way I approach it is like finding a partner, which can provide you the flexibility and thinking through sort of like future thinking and thinking about the compliance, right? So leveraging technology and expert collaboration for compliance. And so for that, it's like you have to figure out who that right partner is going to be for that retirement plan. Will their software take care of like tracking for compliance, integrate with a payroll? And so that, that is sort of the way an HR professional can tackle that. And I think what is really great is, especially Ubiquity's 316 services, those are compliance experts, right? So if you have a question, they'll be able to get you that information and ensure that you have compliance around your plan. So that's sort of, I think my insight is minimalistic because you covered most of the ground. I love that, Chad. Make my life easy.
Thank you both. And moving from the map to other mysteries, what are some common 401k myths that prevent small businesses from offering retirement plans? And how does Secure 2.0 help address these misconceptions?
So I'll start with that one. One of the myths that small businesses have is that it is costly and complex. And so the way we try to help them understand and demystify that is that I've shared with you the costs. On a relative basis, it's not that expensive. And now, especially with the tax credits coming from the federal government, costs should not even be in the equation for the first 3 years. Complexity, it is true. It's a complex environment, but that's why companies like ours exist. We are your buffer. We take care of all the complexity and we shield you from all that. And if you just listen to us and we'll listen to you, we ask you what you're trying to accomplish. Are you trying to maximize savings for the owners? Are you just trying to offer a benefit for your employees? Are you looking for something that can do both? That's where our expertise comes into play, and we can make a plan design recommendation which will accomplish your goals. Then once we do that, as long as you pay attention to us and do what we ask you to do throughout the year, which is very minimal, then you won't have to deal with the back end of that complexity. So that's why companies like ours exist. Other myths are, and this is one I really like, because many people have been exposed to 401ks in other organizations, and usually in some cases they worked at a larger company, and they would have had an employer match, which is a great benefit. So with that in mind, a lot of employees and or a lot of small business owners have the misperception that a match is required, but it is actually not. Matching is always optional. When we're talking about putting a retirement plan in place for your employees, what you're doing is you're providing that mechanism for them to defer their own income into a tax advantaged account. That's it. Everything else on top of that is optional. If you want to do a match as an employer, you can. If you want to do a profit sharing contribution instead of a match, you can. And again, that's where our expertise comes in to help you. The myth about the match is very interesting to me because that's what keeps a lot of businesses out of even entertaining the idea of putting a plan in place. However, once we have the opportunity to talk to them and we find out what they're trying to accomplish, and we explain to them this unique provision in 401ks called safe harbor, which some of you may be familiar with. It's a way of saying that if you're willing to do a match on behalf of your employees, and there's a formula that we can help you understand, then you, as the highly compensated employees in the company, will not have to worry about so much these unique and complex compliance tests that could potentially limit their own savings ability. Now there's 402G, 401A, I mean, there's all kinds of stuff which is out there, but we don't want to confuse you with that. But just simply say the myth of having to do a match keeps people away. And in our experience, once we educate them about what the benefit of doing a match is, how they can themselves get higher savings limits by default, 55% of our clients end up implementing a safe harbor 401k. I mentioned briefly the complexity of investments, thinking that they have to choose the investments on behalf of their employees. That's not the case. You can obviously hire, we help facilitate this, and there's plenty of people out there, what is technically called a 338 fiduciary plan advisor. It's a mouthful, but there are people who are professionals who that's all they do. They monitor and they pick investments based upon performance and expenses, and they make sure that you as a plan sponsor have the best investments available to you in your plan and are always adjusting that depending on market conditions. So it's one of those things where it's not a DIY as much as you may think it is. There's a lot of DFY done for you in this whole process.
Thank you, Chad. And how can small businesses future-proof their retirement plans and integrate financial wellness into their strategies with upcoming legislative changes?
I'd love for Mona to take that one, but she's looking at me like, you better take that one.
No, that's totally fine. I think the best thing is, of course, like staying up to date of what potential changes are coming depending on the state you're in, ensuring you're with a plan that is flexible and forward-looking, because you want your provider to take care of that for you. Just in the instance when you like sign up for a payroll provider in the state, you're like, you are going to take care of ensuring the taxes get paid and all that stuff happens. So finding that provider who is going to, like, even if you don't start with the end-to-end services and you start with a plan and you didn't, get all the services, have a forward-looking plan that will grow with you. Educate your employees, right? It's just like as an HR professional, sometimes I'm like, wait, what? The employees have a similar experience, right? Our job, it may not be necessarily demystified completely, but to the extent that we can make it simple, bite-sized, and tying it to their financial wellness, we should be able to do that. And staying agile, right? Like staying ahead of the curve. Work with plan providers, work with retirement plan providers that are forward thinking and can take care of your needs, rather than a lot is available out there. And what I have learned through my career is that there is in the bigger 401ks, the hidden cost is high, right? So find something that is a simple solution that grows with you and is good, like is an easier solution to implement if you're already not in a plan, right? So that's how I would think about it. Chad, did I miss something?
No, that's great. The metaphor for me that comes to mind is some of us on the call are probably similar ages, and we remember riding in our car, and our seatbelt was our parents' arm slung across us when we were stopping too
Right.
fast.
Yes.
So just like cars have changed and technology has changed, now we have 3-point restraint, we have airbags, we have anti-collision, we have all that stuff. Retirement plans have changed too. And to Mona's point, make sure that you're not driving a 72 Chevy. Make sure you've got a modern car as your vehicle for your 401k plan. And and to answer Ty's question, as legislation continues to evolve, as states come online, as we're already contemplating Secure 3.0. I'm at an industry conference right now, and there's been a lot of talk about Secure 3.0, and none of us know what that means in terms of what it's going to do. So we're all ready for it. We're all contributing. We're all sharing our best practices and what we'd love to see. But again, to Mona's point, make sure you're working with a great provider who's going to stay forward thinking and stay right there with you. And that I will say that, not to disparage any of my competitors and some of the legacy companies, but they're not always investing in their technology and in their future.
And what strategies can small businesses adopt to ensure smooth implementation of Secure 2.0 changes?
I would start by saying, remember, there's certain ones that are required and there are others that are optional. Make yourself a checklist. Make sure that those that are required, and know when the time frame by which that requirement is going to become active.
I really like to keep things simple, like make sure what the requirements are met, like the auto-enroll, auto-escalation, the age catch-up, all, like make that list, make sure your plan takes care of the minimum. If you want to go beyond, like the student loan repayments, and depending on sort of the demographic of your employees, like you can have the nice to haves as a future implement, but initially ensure that that is the case. I would say if you don't have a plan and you're in the states where it's like getting to the place where you have to implement a plan, ensure like your plan has an integration with your payroll provider as well. A lot gets thrown as 360 integration. That's actually, take it from the gray hair. Sometimes I'll sell you it, but it really isn't that. And so, Chad, welcome back. I was talking about, following up on your checklist and what to prepare. In addition to communication, the payroll providers, and they talk about 360 integration, and you and I were having that conversation of like, that is such a misnomer. So do you want to talk about that payroll 360 integration piece? I love when are you back, Chad?
I think it may be the audio.
Okay.
That's, yeah.
Okay.
Oh, there we go.
So sorry, yeah. Did you miss me?
No,
apparently the hotel's
not at all. I get it. You're in a hotel. Yeah.
It was done with me. It's like, no more talking. So hopefully you answer the rest of that question, Mona. Sorry.
I did. We were talking about the smooth implementation. I followed up on your checklist thing. I was like, hey, from where you start ensuring like all the compliance pieces are done to like the nice to haves. And I was suggesting like ensure that there's integration with your payroll provider, And I was saying, I've got gray hair, like with these integrations when they promise you a 360 integration, but it really isn't there. And what you really need is not all the bells and whistles, but ensuring like data integrity exists, right? And I was saying, you had last week when we met, you had a great anecdote about it. So I was like, hey, Chad, do you want to take it from there?
If I could remember, what was the anecdote?
We were talking about like the data points, like 5 data points need to go in, but only
okay.
2.
So that's fair. Yeah. So you'll hear a lot of talk about 360 integration, 360 degrees. It sounds great, right? It means data comes down, data goes up. Our industry has done a good job of trying to make sure that everybody understands that that's the best desired state. However, my personal view of it and the reality is that it's a bit of a misnomer. The two 180 degrees are not equal halves of data. So what we mean by that is definitely data coming down from the payroll company or the HRIS system or whichever platform it is we're using is super important for our ability to know we have good data and also to do all the processing that we need to do while making it easier on the HR professionals so that they don't have to move that data themselves or key in that data themselves. So there was maybe 10 or 12 points of data that come down in any given period. Name, identifier, current hours, wages, amount deferred, if there's a loan payment, if there's a profit sharing contribution, if there's a match contribution, if this is Roth, if this is pre-tax, you all get that. You probably exposed yourself to that. So that's the 180 down from payroll to us. The 180 up from us to payroll usually is only 2 or 3 data points. And that might be deferral, either dollars or percentage, whether or not there's a loan payment and what that dollar amount is, and really any other status change that the employee might have indicated. The problem with the idea here is that, again, there's not equal weighting and it's not equal importance. There's an idea of if an employee wants to change their 401k deferral amount, do they go to payroll or do they go to the 401k platform? I've been doing this 25 years and everybody says both. So it has to be determined which way does that data flow. And there's no wrong and there's no right. It's just there has to be a single source. So don't get too hung up on 360. It's a nice to have, but the 180 integration does make your lives easier.
Thank you.
Great. Thank you. And sticking with data, how can businesses measure the success of their retirement plan changes under Secure 2.0?
So the standard metrics that we use to measure success in our industry, one, first and foremost, is a participation rate. How many of your eligible employees are actually actively deferring some of their income into the retirement plan? And there's broad swaths of industry averages. It's kind of not fair to use big averages because we're talking about large companies. So we need to break that down into small companies so you can benchmark yourself and say, how am I tracking? But really, sometimes that can also be misleading because, in a 10 or 12 or 20 person company, you're just not that big. And, there's a strong word of mouth in the organization. And certain folks, maybe just for other circumstances, maybe their spouse has a plan available and they don't need to use this plan. There's a lot of reasons for why somebody may not participate. But to Mona's point earlier, as long as you've got strong communication and you've encouraged participation and you're utilizing auto-enrollment, your gauge there should be, my rule of thumb is if you can get to at least 70% participation, that's a pretty good spot to be in. And of course, all the higher. The other metric to use would be, which a lot in our industry like to measure this because they get paid on the assets. We don't get paid on the assets, so it's important, but not for the same reasons as it is to the others. But basically, how much are people saving? As a percentage of their paycheck, as that accumulates, what does that look like in terms of the money that's been set aside by your employees? And how does that compare to the life cycle of where they are in their savings? And then eventually where that will grow up to be. Are we on track? Are we like everybody else? Are we going to be average or above average or below average when it comes to our cumulative savings? So really it's participation rate and money being saved are the two biggest. And then to a lesser degree, and not many folks focus on this, but ensuring that the individual employees are actually in investments. That if they've been defaulted, that's going to be a given. But if they're not in investments, just take a look at that and make sure that if you want to go a step above and beyond, and you want to engage those employees who maybe haven't chosen investments, make sure that they did that as a positive affirmation, saying, I don't want to invest. And that's totally fine. Some people are so risk averse, they don't want to see a market drop. They don't want to see their money go down. And there's no problem with that. I myself am very conservative when it comes to investing, but it is the idea that make sure that they understand that they had the option to do so. Because this whole point of long-term savings is it will grow, and it will grow and compound. It will grow and compound in a tax-deferred status, and that's the real magic of the 401k plan. And so those three things are really the best benchmarks you can use to measure success in your plan.
I think from an HR perspective, Chad, to me, it is like for a retirement plan or a 401k plan, people are usually set it, forget it, and then you have a more active participation base. So I would say from an HR practitioner perspective, all the metrics you suggested, really good. With the auto enroll feature, it'd be interesting to see the drop off at the 30-day mark, like how many people opt out. So that would be an interesting data point. But I think it'll probably be lower, and it'll drive towards like 70% participation in the plans and what have you. I think what I like to see in like after you have people in the plan, you begin to see more engagement, right? People will become and be like, hey, I want more investment options. Like, are we staying? And so usually whenever HR practitioners send out their employee engagement survey, if they do that, you'll put a 401k question, people will be like usually extremely satisfied till they get really savvy. And then you're like, I want more investment options. We should have a better plan, right? And so that's just anecdotal data. And I would say just like in the bajillion years I have been in this profession, I think where I have seen value is when people have a hardship, right? Like, or when they have, they want to take out a loan against the 401k for purchasing a home. And then they were like, thank you, Mona, for telling us to put this money here. Now I can use it as a vehicle to purchase a home. And so I think that, like, not like as a metric, yes, do an employee sat survey, do your education, track participation, track the dollars in your amount in the retirement plans. But I think the gratification that comes from people actually utilizing those funds is incredible.
That's a great point. Yeah, the satisfaction and the gratification that the employee should have. And then as an employer, that will only work in your favor, as Mona talked about earlier with those statistics. The number of employees looking for retirement benefits when they're considering a new job is, in that high quartile. And also the number of employees who would potentially leave a position because the lack of retirement benefits is high. And there are studies, and I think SHRM has done them and others, that can equate to a real, actual hard dollar cost that turnover has to a business. And I've seen stats anywhere from $3,000 to $3,500 per employee per year. You multiply that by 10 or 20 employees, and then we're back to that could be your profit margin. So these things do matter, even though they're very difficult sometimes to see the forest for the trees.
And I have one last question. What next steps would you give small businesses navigating Secure 2.0 and focusing on financial wellness?
Mona, you want to go first?
I think from an HR perspective, the focus on financial wellness as it pertains to employee engagement is, there's no doubt that those two are related. I think there is a lot of, at least, and there'll be new studies that'll come out next year. The last few years have caused a lot of financial stress for people, right? And so where the industry has, where especially tech has been, right? And so people are looking, to participate in a retirement plan. People are looking for the larger picture of their financial wellness. And so I think this is a great, as much as in my initial hesitation of Secure 1.0, Secure 2.0, I'm like, actually, this is really good, right? And so I take it as like, this is good, right? But Chad, you can round that out.
So, as we're coming up on year end, my own company and a lot of others are doing 2025 planning. We're looking at our budget, looking at our forecast, looking at our roadmap, our goals, our objectives, our key results. On a personal note, a lot of people, New Year's Eve, they make resolutions, right? So the challenge, I have for everybody out there is, let's make this the year. Let's make 25 the year that you get into it, that you get going. We've shared some information with you to hopefully demystify a lot of these complexities. We've shared with you the fact that the federal government is so serious about it, they're willing to pay for it. So don't look that gift horse in the mouth. We've worked hard to get these benefits, and we need to utilize them before they're gone. and just don't become a victim of that inertia. Don't let the how stand in the way of the why, because I do believe that the why is very powerful and very strong. And as you take that first step and you engage companies like ours, we're here to help and get you on that path, and to be very consultative in doing so. That's the whole reason I started the company out of my financial planning practice, was because my mission was to get more people, give more people the ability to save for their own retirement. Because in today's day and age, it's frankly a travesty that we face this situation in our country at this time that we do. But all the tools are available to us, so now it's up to us to take action.
Thank you, Chad and Mona, for all of your insights and guidance. To remain on schedule, we will respond to the questions that came in by chat via email in a timely manner. So with that, I'll turn the floor back to you two for any closing remarks.
Chad.
Well, thank you all for the opportunity to share our knowledge with you. Everybody has a role to play in this economy. HR practitioners play a very important role, bridging rules, regulations, benefits, but also the people, the culture, the satisfaction of employees, the caring and oversight of employees, helping them to get the most out of their jobs, but also to help them get the most out of their lives. And so, as specialists in the retirement savings space, I just want to leave you with, the fact that, we're doing this because we care. We're not doing this to necessarily enrich ourselves. We saw a big problem and we try to create a solution to fix it. And so that's my parting words. Mona, you?
I'm going to go off script. Come talk retirement to us. I never thought those words would come out of my mouth, because initially when I started as an HR practitioner, retirement was this like big, giant, hairy ball of like, I don't understand this. Please don't make me do this. But the industry has evolved, as technology has evolved in this space, and also like our solutions. I'm like, oh my God, this has been made so simple, thanks to the tech investments we're making, that I can actually say, come talk retirement to me.
Yeah. Awesome. Thank you.
Yeah.
Thanks again, Chad and Mona. And with that, on behalf of HR Morning, I'd also like to thank everyone for attending. This concludes our program.